Welcome back. Today, we're diving into part 2 of our explainer, looking at the rules and the REIT spectrum, 4 tests and 2 types. Let's build on what we already know and discover the legal guardrails that actually keep REITs honest.
So, we already know a true REIT requires pooled capital and a massive 90% payout. But wait, you might be wondering, what legally prevents a bad actor from just slapping the word REIT on their company and gambling your hard-earned investment on some super risky side bets? I mean, what stops them from taking your money and day trading crypto or funding a wild tech startup? Well, the answer lies in the law. If they miss even one of a few strict regulatory tests, those amazing tax privileges that make REITs so profitable, they literally die instantly.
Here are the 4 statutory gates every single trust absolutely must pass. Gate 1 is that 90% payout rule we just talked about. Gate 2 is the 75% asset test. This means at least 3/4 of a REIT's total assets have to sit firmly in real estate, cash, or government securities. No funny business. Then we have Gate 3, the 75% gross income test. Basically, 3/4 of all the money coming in must come strictly from rents, mortgages, or property sales. And finally, Gate 4, the 5 or fewer rule. This dictates that no more than half the shares can be held by 5 or fewer individuals. Put them all together, and these rules basically force the REIT to stay a boring, reliable landlord.
Now, why jump through all these hoops? The massive payoff for passing those 4 tests is completely avoiding corporate double taxation. Your gross rental income flows to you with way fewer scissors cutting into it. You see, a normal corporation is notoriously taxed twice, first on its corporate profits, and then a second time when you, the shareholder, actually get your dividends. It's a bummer, right? But a REIT that follows the rules and distributes at least 90% of its income gets to completely deduct those payouts from its taxable income. In markets like Singapore, the tax at the trust level effectively just disappears. It's the exact same rent being collected, but with far fewer scissors snipping away at your returns.
Okay, so this strict structure shapes the broader REIT universe, which actually splits into 2 very distinct vehicles. And you absolutely have to know the difference between tangible equity REITs and highly sensitive mortgage REITs. When most people talk about REITs, they're talking about equity REITs. These are the funds that own physical, tangible buildings. We're talking shopping malls, office towers, logistics hubs. They collect contractual rent, and that physical property tends to appreciate over time, acting as a fantastic hedge against inflation. On the flip side, we have mortgage REITs, or M-REITs. These trusts own 0 physical property. None. Instead, they just hold mortgages. And their whole business model is profiting from the spread between short-term borrowing costs and long-term interest income. So they're fundamentally just a massive bet on interest rates.
Think about it like this. An equity REIT is like a chicken rice stall that actually owns its physical shop. They pull in a steady income, and if inflation hits, they just raise the price of the chicken rice because, well, they own the physical location. They're steady, they're tangible. An M-REIT, on the other hand, is like a stall that borrows cash at 4% just to lend it to someone else at 6%. Their entire existence relies on that tiny 2% gap. It's like riding a super wobbly seesaw. If borrowing costs suddenly jump higher than their lending rates, that seesaw violently tips and their whole business model starts bleeding out.
And we actually saw this happen. When U.S. interest rates spiked over 4 percentage points in 2022, that seesaw violently inverted. This caused several really big M-REITs to slash their distributions by a catastrophic 30% or more. While M-REIT yields can look incredibly seductive on paper, especially for beginners, that yield is actually incredibly fragile. When the spread between borrowing and lending compressed and inverted during that massive rate hike, the payouts just completely collapsed. Meanwhile, the equity REITs, our trusty chicken rice stall owners, just kept collecting rent and serving up steady distributions because physical tenants still needed physical space.
All right, time for a quick pop quiz to test your new knowledge. Let's see if you can spot an imposter portfolio before it touches your money. Imagine you're looking at a flashy new trust offering this amazing yield. You look at their holdings and see they have 60% of their money in physical property and 40% riding on high-growth tech stocks. Based on the rules we just covered, does this qualify as a real REIT?
Absolutely not. It completely fails the 75% asset test. This is exactly why you must always check what's actually inside the box before trusting a company as a tax-advantaged income machine. Now, it might actually be a perfectly fine company, and hey, it might even make you money, but it does not get that special REIT tax treatment. It's not the legally protected double tax bypassing income machine you're shopping for. So remember, never just look at the name of the fund. Always look at the underlying assets.
Let's do a quick recap. You now understand the 4 guardrails that keep a trust honest.
The 90% payout, the 75% asset and income tests, and the 5 or fewer rule. You know that passing these tests is the secret to unlocking the double tax bypass that totally supercharges your yield. And most importantly, you now know the golden rule of thumb for anyone starting out. Stick to the steady inflation-resistant equity REITs and leave those wobbly REIT seesaws to the macroeconomic day traders.
So, now that you can screen out the imposters, it leaves us with one final, pretty provocative question that we're going to tackle in our next explainer. How do these perfectly regulated machines actually stack up against the rest of the investing world? We know REITs are clean, highly regulated income generators, but if you had $100,000 right now, would you be better off buying shares in a REIT, putting a down payment on a physical condo, or just throwing the whole shebang into regular growth stocks? We're going to put all three in the ring and score them dimension by dimension next time. See you then.